with that said, we're going to get into Chapter 21, and I'm doing Chapter 21 first for a couple of reasons. Number one, it articulates very well with Chapter 14. In Chapter 14, we talked about long-term debt, we discussed amortization tables, and we talked about the interest rate method of amortization, discounted cash flow valuation, and everything that's in Chapter 14 will apply to leasing as well. In addition, leasing is very important for us to lay out, I think, the structure of this course in Chapter 21, because not only is leasing widespread, but there are a couple of things that we're going to be looking at in this chapter that I think will really permeate throughout the entire discussion of the course. Number one is that we're going to look at IFRS versus U.S. GAAP, rules-based U.S. GAAP versus principles IFRS. So that's going to be something that's going to be very clear. The other thing that's important is I think we're going to start, and I'm not going to use this all the way through, but on Blackboard we have these articulation worksheets, or these modeling worksheets, and I'm still going to really ask you, I know you don't do it all the time, but this is the way you have to think about accounting. How does a transaction affect my income statement? How does it affect, and you'll find these on Blackboard, how does it affect the balance sheet? How does it affect the statement of cash flows? I'm actually going to use them in this module. We're going to finish today's session with a review of this for leasing, but I think you should use it all the way through anytime you look at a transaction. Debits and credits are important, but understanding the analytical implications, and we always come, as you know, from an analyst or a user's perspective, and that's the way I want to take this as well. And I think also you'll find that this particular topic helps you to understand how we operationalize theory. So this is a very theory-heavy part of accounting, Intermediate 2, when we deal with leases, pensions, earnings per share. There's a lot of mechanics, but you need to understand the theory and how to operationalize that theory through the mechanics. So let's go through, let me put this up on the screen for you, and I will try to use the board a lot more this semester as well. So here's what we're going to be looking at today, and we're going to finish this one module. I'm going to come back and review a few things with you on Thursday. We won't do any questions today, so that you have a chance to make sure your clicker's registered, and I have to make sure the person next door is not using the same channel because, I don't know, did Rosie use clickers? Or she might. So got to make sure she's not on the same channel. So I'm going to introduce you to leasing theory, the concept of finance versus capital leases. We want to go through some lease terms. We want to look at the lessee and then the capitalization criteria, and then we're going to go through some basic illustrations. So the first thing we need to think about is, of course, and by the way, this comes from the Accounting Standards Codification in Section 840. If you are, again, if you came off internships, I don't know how much you used of this. I know the CPA exam is going to involve a lot of the codification. Codification is on Blackboard. You have access. You have a username and password. Go in there once in a while. I always recommend that for you as well. All right, so let's take a look at the basics. We're going to go through the terms. And again, I realize they're listed here. You're not going to memorize them. You have to understand how they fit into the framework of not only the theory, but the application of that theory. So first, you should know that a lease is a contract, and that contract is going to involve these two parties. Lessor, of course, is the owner, and then, of course, you have the lessee, who is the tenant. Now, the lessee has the right to use the asset. And I'm going to use this terminology, and I don't know if you picked this up, you might have on internships, but right now there is an exposure draft out. And this has been going on for a long time, but the latest exposure draft on changing the lease standards is released on January 23rd. The board, the International Accounting Standards Board, and the FASB met, and they're really going to drill this thing and nail it and probably release it this year, effective 2017. Now, you got some time, but I want to make sure that we start to address some of the issues in that new standard. And in the new standard, the idea is that there is an intangible right of use of the asset. In fact, the asset is called the right of use asset. And the right of use comes with, of course, making payments, lease payments to the owner. Now, the key issue is that this contract is not giving you title. So legally, you don't own the asset, you simply have the right to use it. But the question that we're going to address is whether or not the asset and the liability for the lessee should be reflected on their balance sheet. Now, I'm going to give you an example that is often used in textbooks or in journal articles, Wall Street Journal. Airlines. Most airlines will have very few jets on their balance sheet. They're going to have very few pieces of equipment on their balance sheet, and they won't have the long-term debt on their balance sheet. How do they do that? They lease, and they draw up the lease in such a way to obtain off-balance sheet financing, which means that if you look at Continental Airlines, they may have 300 planes in service. 70 of them are on their balance sheet. The other, 230 are not. It's almost like having a zip car or an enterprise rent-a-car. It makes no sense. So based on the standards we have now, they're faulty. They're deficient, and that's why we need to change them. And the new standards will probably result in having all of the assets and all of the liabilities on the balance sheet. But right now, this is the game. The game is whether or not this contract, although it doesn't pass legal title, whether or not the lessor reports this as a sale of the asset to the lessee. So the question is whether or not this asset should go on balance sheet. So the question is whether or not the asset and the liability should go on the balance sheet. So whether or not you have a leased asset and a lease liability. Whether or not you report that, and that's the question. Now, that will depend on the terms of the lease contract. So let me go through some of the terms with you. Again, not to memorize them, but to have this information available so that you can properly interpret the lease. So let's take a look at the first one. And the first one says, the duration of the lease. How long is the lease term? Now, that will in fact be very influential on that decision, because if the lease term is 1 month, should the asset go on your books? If the lease term is 10 years, well, is there a difference? Are you using the asset? Are you consuming its benefits? So these are some of the things we need to think about. But right now, the contract could specify, and again, title may never pass, but the contract will specify whether or not the lease is a fixed term or renewal options. And when we look at renewal options, you have to distinguish between whether or not that renewal is a fair value or a bargain renewal. So, for example, a fair value renewal means that if, and this doesn't apply to auto leasing, individuals, but let's say you're leasing a Nissan Altima, and the payments are $199 a month. It's a 3-year lease, at the end of the lease, there is a clause or on the bottom of the contract that you could renew this contract for $89 a month. Sounds like it's probably, for a 3-year-old car, probably fair value, right? If, however, it says that you can renew the lease for $10 a month, that's a bargain renewal. And that bargain renewal will be built into the contract, and it's going to have implications in a couple of ways. First, if there is a bargain renewal, it impacts what we consider to be the total lease term. So if you're looking at a lease contract, and you're going to be looking at different, in the course, you're going to be looking at different variations of the lease contract. So if I asked you, what is the term of the lease? If the lease is a 5-year lease, but there's a bargain renewal for another 3 years, as far as we're concerned in our analysis and applying the accounting standards, this is an 8-year lease. So from our perspective, if there is a bargain renewal option, this is going to be an 8-year lease. Because the assumption is that that bargain renewal will be taken, that you will take the bargain renewal option. You wouldn't know, because this is on the date you sign the lease. So that for us, so for example, for us, if we're looking at, we need to know the total lease term for certain parts of the accounting. Well, in the event there's a bargain renewal, on the day we sign the lease, we have to assume that you're going to take it. Now, it's interesting, I'm going to come back to this, but under IFRS, if there's a bargain renewal option, it could trigger a capital or a lease that is put on your balance sheet. So IFRS is a little different, but for us, we'd have to think about it whether or not it extends the lease term. Okay. All right. Next one, periodic rentals. For us, we're going to keep it simple. We have level payments for our class. In practice, you could have contingent rentals. Real estate leases typically will have contingent rentals, so that you pay a flat rate, $10,000 a month, plus 20% of sales. Some retail leases, so for example, Tiffany's at Short Hills, they could be only paying 20% of revenue. I mean, and that's sort of, I think, reasonable for the mall, because the mall has to keep up its appearance, it has to keep up safety, parking, whatever else, security, and therefore that is something that's, responsibility of the owners of the mall, and they would in fact be willing to take 20% of revenue. If the mall does something that lowers sales or reduces traffic flow, then it's not up to the retailer to bear that loss, and that would lower their rent. So basically it ties the rental level to the level of traffic, mall traffic, or basically its location. The better the location, the more revenue, and therefore the higher rent that you'd pay. So you could get contingent rentals. This next one is absolutely critical for us, and this is known as executory costs. Who pays for the maintenance, the insurance, and the taxes? Now, I know in reality there's going to be some kind of a combination here, but technically, I mean, who do you think pays for this? Does the owner or the lessee really pay? Who really pays for all of this? Sales tax, insurance, maintenance. Think about an auto loan, an auto lease. The lessee. Yeah, the lessee pays for all that. But the question is, how is it going to be paid? So where do you give your sales tax? who do you pay it to? You pay it to the leasing finance company or the dealer, right? So in your lease payments, there's sales tax, correct? Your auto insurance you pay on your own, and the maintenance, it depends, you probably pay it on your own. So in all cases, the lessee is going to pay. So with respect to executory costs, this is a lessee expense. This is a lessee expense. And you might have heard or have seen these Mercedes leases that say it's free maintenance. You're paying for it, right? I think. Yeah. So somehow it's built into the lease payment. Now, they could pay it directly to third parties, and that may be an assumption we're going to make. So we'll assume that you pay, and this won't happen, I know in reality it's going to be some combination, but for the textbook we have to think about a way to make it clean so that the lessee pays sales tax to the state of New Jersey. They would pay maintenance to whoever fixes the car, and they would pay insurance to their insurance carrier. Or we're going to include in the lease payment it's paid to the lessor. It's paid to the lessor, and the lessor remits. So you pay just on the lease, you pay the sales tax to the dealer or whoever you lease it from. They give the sales tax to state of New Jersey. Typically the lease is from, let's say, Mazda Credit. So they would have to obviously give it to the dealer to cover it. But if it's an internally financed deal, then I know what you're thinking. Yeah. Okay. So we're going to see this both ways. We're not going to have a combination. So it's either going to be all paid to third parties or paid to the lessor, who then creates a liability to remit. Now, when you covered whether it was accounting for managers or the accounting principles course, did you cover anything like sales taxes at all or payroll tax at all? Well, sales tax works the same way. It doesn't have to be a lease. If you buy a product at a store, even if you go to the bistro, there's sales tax, let's say, could be, or wherever you're buying it. That sales tax has to be remitted to state of New Jersey. Okay. Now, the key point, though, for the executory cost is that when we look at the valuation of the leased asset, the asset is typically equal to the present value of what we call minimum lease payments. The minimum lease payments, I'm going to go back over this a couple of times, and everything we do, as you should know from last semester, I like to put things up front and then keep coming back and building. So minimum lease payments exclude executory costs. So if there are executory costs included in the lease payments, you have to take them out. Why? I want to get the value of the asset. I want to find out the value of the asset. I want to know what the asset's worth. So for example, if you buy a car and you pay $30,000 for it, that could be with the tax. So if someone asks you, what did the dealer charge you for the car, you're not going to add tax. You're going to say 28. I got the car for $28,000. $28,000 is without the sales tax. That's the value of the car without the tax. So we have to exclude executory costs. So when we value the asset, and all our calculations will be based on minimum lease payments, which I'll define in just a minute, which will exclude the executory costs. Okay, because we want to find out the pure rental. What are you paying for the asset? Now we know there'll be interest in there, but what are you paying for the asset? Okay. Now the next three, when we look at these three, let me just color that up for you. Okay. So if we look at the items in green, they are the same as some of the provisions we saw in the debt contracts in Chapter 14. Remember the bond indenture or the debt contracts? Lease contracts can in fact be the same as debt. And that's the whole issue that we're going to be talking about today and throughout this module, that regardless of whether you call it a lease, there are investment banks, commercial banks, rating agencies that see this as debt. A lot of these contracts have restrictions that are imposed on dividends, just like long-term debt. Penalties for cancellation, early termination penalties, and also provisions on default. What happens if you default? Is there a repossession? Same thing as if you bought the asset using a long-term loan. And finally, other options at termination. Is there a renewal option? Is there a purchase option? You know, you could have a purchase option, and again, we have to assess whether or not, when we look at this purchase option, whether or not the purchase option is a bargain purchase option or a fair value purchase option. So that on the day you sign the lease, the question is, I can buy the asset at the end of the lease, automobile. Let's say it's a $30,000 vehicle. You lease it. After 3 years, the dealer said you could buy it for 15. That's probably fair value. If the dealer tells you in the contract you could buy it for 1,000, that's a bargain purchase option. So the bargain purchase option, as we'll see, is an option to buy the asset at a price that is substantially below its expected fair value at the time the contract expires. So these are the terms that you have to look at very carefully, and we will see that throughout all of our examples in this module. Now, obviously leasing is growing, or it's permeates almost all corporations. And let me just summarize some of these advantages and disadvantages. And I think the first thing you have to think about is the idea of this notion of that the lease contract is going to really keep most of the risk of obsolescence with the lessor. So let me go over a couple of things with you. I'm not going to go and read these with you, but I mean, obviously there are some substantial benefits for leasing for the lessee. You know, obviously, you know, there's no money down in some of these leases, so you can get complete financing. In other cases, and you can read this obviously, but you know, business and financial flexibility. What this means is that from a business standpoint, it keeps the company very flexible. So after 3 years, I could either buy the asset if it comes off lease, I could extend the lease term if it's in the contract, or I could opt out of the lease and lease another asset that's what? Technologically more advanced. So it allows the company to stay on the cutting edge of technology without getting strapped with the asset. On top of that, there could be some tax advantages as well. And I'm going to talk about this loss or this risk of loss in a moment. But when you look at the tax benefits, I'll just give you a couple of ideas. One of the ideas is that if you, let's say, lease a building, and let's say, that, I forget what Rutgers is doing here. I think it's like they bought the floors in a sort of a co-op fashion. But if they were leasing these floors for 30 years, and they're just paying rent expense, if this was a corporation or Audible, if they're renting the floors, they can debit rent expense, credit cash, and for tax purposes, and that's why we're going to ignore tax for this chapter, because in most cases, corporations like to get that rent expense. The reason for it is if they capitalize for tax, and you could have a capital lease. In other words, you could, for tax purposes, have an asset on your books and a liability. But for most leases, they have what is known as a true tax lease, and they deduct rent expense. What's the advantage? If it's a building, no one's worried about land not being depreciable. If you bought the building, what's the problem? The building depreciates, but the land doesn't. So you can lose a tax deduction there. The other disadvantage is the alternative minimum tax, which I don't know if you picked that up in the tax course, but it affects all of us. I mean, it's going to, I think the threshold is very low. It's about, and I say low, 100,000, but you might say, well, that's not my starting salary. Well, yeah, married couple of years, you hit the alternative minimum tax almost 100% of the time. And the alternative minimum tax is a way for the government to look at your use of what they call tax preference items. What are tax preference items? They're accelerated depreciation, they're tax-free bonds, and here's the way it works. Here's my example. Now, it's not exactly like this because obviously there are some exemptions and the like, but if you look at this example, we have the regular tax and we have the AMT. Now, the regular tax, I'm saying that your taxable income is $4,000. If your tax rate is 34%, the tax is $1,360. That's your regular tax. But that taxable income is after tax preference items were taken. So tax preference items, as I said, could be tax-exempt interest, or it could be accelerated depreciation. And when you buy an asset, you've got accelerated depreciation. So here's what will happen. You're going to take the $4,000, tax preference item, which in this case is excess tax depreciation. In that case was 29. Your AMT income is $6,900, and by the way, there are some exemptions, but the AMT rate, let's say it's 20%. The alternative minimum tax is $1,380. So you pay the higher of the two. So you're going to wind up paying the AMT. And that happens, and I'm not a millionaire. I got a couple of tax-free bonds, and other tax preference items are what? Income tax deductions that you take on your state taxes. So on my federal return, I deduct New York and I think New Jersey too. I forget how it works now. Someone does it for me, but I pay in 2 states. And when they add that back, when they add back the tax-free bonds, I pay maybe $60 more or something like that. I mean, but I have to pay more. So you have to pay the difference. And the way it works on the tax return is that there's a section and they'll just add the $20 in, basically. So if you lease an asset, you don't trigger excess tax depreciation and you avoid the AMT. So leasing has that advantage as well. Now, you also, the other advantage of leasing, we say that it does what? It will keep the risk of loss with the lessor. I think so. I mean, but you know, that's a question I'm going to ask you probably on Thursday. Asset becomes obsolete. It's got to be returned to the lessor, right? So that risk of loss is typically viewed as being absorbed by the lessor. Now the question is that in your mind, we're going to discuss this again I think on Thursday, but in your mind, is that 100% correct? Does the lessor have a way, or are there ways to pass that along to you? Yeah, higher lease payments and residual values. So, yes, they're stuck with the asset, and they may have to, if it's completely obsolete, they may have to pay money to scrap it, but they're going to wind up having a way to absorb that risk of loss and even move it to you as the lessee. And they can do that through lease payments and a residual value. And by the way, the lease payments and the residual value could be built in as a trade-off. Now, it depends on the asset. But I've seen some leasing, even auto leasing, where if the contract specifies a higher residual, your lease payments will be less. But that means when the asset comes back, it's got to be in a condition where they can get more money. And therefore, you can't obviously drive it a certain way. The asset has to be maybe very low mileage. They'll work something out, because don't forget, let's say you put 36 or 40,000 miles on the car. If that's how you're going to drive it, then the payments have to be higher because the residual is lower. If you can structure a lease where you're going to use the car for 10,000 miles, then maybe they'll make the payments lower, but the residual value's got to be higher. And that will obviously offset. But this is a big question then, is whether or not the risk of loss is going to be pushed into the lessee's corner. And that is part of the incidence of ownership. So that's going to be all part and parcel of whether or not we treat this asset as if it is owned. So that, again, will be something we'll get back to. So those are pretty much the advantages and disadvantages of leasing. And I just want to leave with this idea of this risk. And I'm going to come back to this because this is going to help us understand a little bit more about the basic theory. Any questions so far? There's one more advantage. Okay, and that advantage is the one that we're going to focus on mostly, and that is this idea of off-balance sheet financing. Off-balance sheet financing means that, especially for the lessee, here it's on balance sheet, so the lease asset and the lease liability would be on your books. That's sometimes called a capital or a finance lease. But if the accounting standards are such that you could avoid this capital lease, you could treat it as an off-balance sheet. Financing. And get what is known as an operating lease. And all you have to do, I'll show you some of this in a minute, just have rent expense and cash. Keeps the asset off your books. Now, the treatment is going to depend on the contract terms. That's why we went over the terms. It's also going to depend on the accounting standards that we use. So what we're going to look at is whether or not a lease should be put on the lessee's balance sheet. We'll talk about the lessor in a moment. Should you record an asset and a liability, or should you keep that off balance sheet? And this is all going to be based off of a couple of important concepts. One is that we're going to try to rely on the fact that, well, look, legally you don't own the asset, but economically it may very well be that the lease contract is equivalent to ownership. So the first thing is whether or not there is economic substance over legal form. Economically, do you own the asset? Do you have a liability? And that will come to be if substantial risks and rewards of ownership are passed to the lessee. And if that's true, then we would record a capital lease. So if there is economic substance over legal form, and that's true, if the risks and rewards of ownership are passed to the lessee, then we record it as if it's a purchase of an asset using long-term debt. So you get the equivalent of buying the asset on long-term debt. And typically, if you look at this next section, basically is what I'm saying, is that the contract, if it's non-cancelable for a term in excess of 1 year, passing all of the risks and rewards of ownership to the lessee, even if legal title does not pass, it's an equivalent of buying the asset with long-term debt. And that equivalent long-term debt and asset is recorded on balance sheet. And this is known as the capitalization method, or a capital or a finance lease. And in the event that you're going to capitalize, you would have, and I'll go through these definitions in just a minute, you would have to record the asset at the present value of those minimum lease payments, or its fair value, whatever's lower. You can never put an asset on its books above fair value. Fair value is always a ceiling. If the, and again I say that right here so to make sure that's clear, that the present value of the minimum lease payments have to be at the lower of the PV or the asset's fair value. You can never record an asset above its fair value. If the lease agreement does not transfer the risks and rewards of ownership and economic substance does not exist, the legal form of the contract would be superior in this case and would result in an operating lease. And it keeps the asset and the liability off balance sheet. Keeps it off balance sheet. Now, what are the advantages? I mean, if you think about it, why would someone, and we're going to find out that the lessee is always looking, whatever way possible, and that's, well, typically looking to keep the asset and the liability off balance sheet. If the tax treatment is the same, if the lease payments are the same, there's no real effect. There's no cash flow effect. So what are the effects? Cosmetic. They're cosmetic accounting effects. So what are they? What are the advantages? What are the cosmetic reporting advantages? We want to avoid capitalization. What are the advantages? Well, if you don't put the asset and liability on your books, let's start with the liability. Ratios improve. Give me a ratio that's better. Debt equity, right? The debt equity ratio is going to improve. Current portion of the lease debt. How do you classify that? How do you classify the current portion of lease debt? It's a current liability. So that means working capital is improved. Because it avoids reporting the current portion of lease debt as a current liability. All right, so working capital improves. Get higher net income in earlier years. Now, to understand that, I want to go back here. What expenses are associated with a capital lease? What happens to the asset? If it's on your books, it's got to be what? Depreciated? So we might call it amortization. I'm not worried about the terminology. Right now, depreciation expense. The lease obligation is going to be effective interest rate method of amortization. You can have interest expense. Now, in the early years of the lease, rent expense is lower than the sum of depreciation plus interest. So that net income is going to be higher. Now, there are some advantages to capitalizing, but these are the primary reasons why we keep the asset and the liability off our books. And by the way, with higher net income and lower assets, what happens to return on assets? It goes up. All right, so return on assets will go up too. So net income is up, total assets. So return on total assets goes up because net income is higher, total assets will be lower. So just to give you an idea, and we'll keep going back over this, how there is an advantage to the lessee to avoid lease capitalization.